Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. And for those of you who are new to the show, welcome. We are so glad to have you here. This podcast is about helping you become a more empowered and more confident investor as you help provide better for yourself and your family's current and financial future. And for those of you who are veterans of the show, it's great to be back. It's been a few weeks since I've last recorded. And as I mentioned, I can't remember if it was late January, early February in the last show that I put out, that I was going to take a little bit of time off after the DIY Investing Summit because that was quite an effort on our end. And so a lot of interviews and a lot of background work for that. But for everyone who participated, thank you so much. It was a great success, and the feedback I've gotten sounds like you thoroughly enjoyed it as well, and I hope that was a great event for you to help provide the training and foundation to help you grow in your confidence and abilities as a skilled and empowered investor of your finances. And so again, that was a great experience and great to be back with you here today. Another thing with the podcast that continues to be an evolving story is how best to use this podcast and what best to provide through the podcast in order to give you the most value and make the most of this opportunity. And there is that component too, that obviously this is a business. And so I'm working on figuring out how best to, again, give you great value consistently through the podcast, but also have a business model behind it that you can, if you want more, you can have more access to training and other components as well to help fund this overall business that is Investor in the Family. So as I'm continuing to think through and figure out how best to use a podcast, what content is best, what do I enjoy most about it, and what's the biggest win for you. Continue to involve that as well. And as always, welcome to any feedback from you also in terms of what you're enjoying about the show, what you would enjoy see changing. You can always email me at Brian, B-R-I-A-N, at investorinthefamily.com. Would love to hear from you. But let's go ahead and get into some content for today and kind of a little bit of update from the last month. And as has been the case of late, I'm going to use the Up and Down Wall Street column from Barron's magazine as kind of a little bit of a guide for what is some bigger news and more worthwhile stories out there to think about for us as investors. And another big theme continues to be the raging bull market that we appear to be in. I think it's getting close to its 8th anniversary. And since the election has just been storming higher and higher. And I think creating there's people have different views on this, of course, but some different levels of potential euphoria, definitely a lot of excitement in the markets that, could be reason for caution in terms of whether or not we could be entering into the later phases of the bull market. But let's go ahead and get into some of this content and talk from there. Some big themes going on is the big boom in buying of exchange traded funds. Like, for example, the SPDR fund, the S&P 500, ticker SPY. The ETF, let's see, it attracted over $8 billion on last Wednesday alone. So there's an inflow of $8 billion invested in SPY last Wednesday alone. And so again, that's just one sign showing just a lot of bullishness out there. And I think that was specifically following, specifically following Donald Trump's speech to the joint session of Congress on Tuesday evening. So the next day was a huge boost in the market. And of course, they make a comment that Donald Trump seems to be taking credit for the stock market's advance, which is kind of funny. And let's see. So basically, but one of the ideas, but part of the things we're looking at here is what is the context and the environment that we're seeing. And one thing is that the stock rally is starting to get a lot of attention outside of the financial media, the non-financial media. Like you're seeing stuff in the New York Times, PBS NewsHour, and things like that are giving attention to the bull market and the big rallies of late. And again, that's one of those ideas. Once you hear people who don't typically talk about investing in stocks start talking about investing in stocks, that's usually a sign that there's a little bit too much excitement, a little bit too much bullishness out there, and people get to a place where they think, hey, we can't lose anymore. We don't want to miss out on this. Is usually when it's a good time to be hedging, pulling out, or making some adjustments, or at a minimum, bracing yourself or preparing yourself psychologically and your portfolio for the fact that the bull market could be coming to an end. And newsflash, the ending of a bull market means bear market. It means 20% plus corrections, typically speaking. And so again, the fact that the Dow has pushed through 20,000 and 21,000 is being noticed. And there's also the big IPO from Snap that happened last week that, according to the article, had a valuation that was over the moon, a very bullish valuation, all signs of extreme bullishness in the markets. And so, let's see. And also that so-called retail investors had been driving the stock rally. And an analyst with JP Morgan made the point that institutions this year have kept their equity exposures unchanged or actually have reduced them, according to JP Morgan's tracking services. And individuals, in contrast, have been buyers of ETFs and driving the rally, he says, and that's not good. Any rally that's driven by retail investors, and because typically retail investors are not considered to be very smart. I hate to break it to you, but there's the idea of smart money and dumb money. And typically retail investors like you and I'm including myself in that, are generally relegated to the dumb money. It doesn't mean you're dumb, doesn't mean you are dumb money, but you fall in the midst of that category, whether it's deserved or not. Sorry about that. And so, again, stocks aren't quite to the point where, you may be talking about them at cocktail parties or with friends at the bar or the coffee shop type quite yet. But as, again, the stock market gets close to its 8th birthday, or the bull market gets close to its 8th birthday, there's really gone along, most of this bull market has gone without a lot of big public participation until recently. And so as far as overall sentiment, the Investors Intelligence polling shows that bulls are at 63.1% of respondents. 63.1% of respondents are bullish, and that's the highest reading since 1987. So we've had 2 significant bear markets since then, and this is the highest reading since 87. And it's had 14 weeks in which the number has been over 55, what Investors Intelligence dubs as the danger zone. So we've been over 55% for 14 weeks, and that's considered the danger zone by the polling service, to whatever degree that has merit to you. And the bull-bear spread, the spread between bullish levels and bearish, people who are bullish versus bearish, is 46.6 percentage points, and the highest that's been during the current market cycle, the current bull market. About 20.4%, apparently we're looking for a correction around the recent level. And then the market's advance. It looks solid from a technical standpoint with small and mid-cap stocks, transportation shares, and overall markets breadth looking positive. But still, stock valuations are worrying, from a broad level, are still worrying. And stocks haven't been as overvalued since the dot-com, stocks have not been as overvalued since the dot-com peak of March 2000. But that doesn't mean that the S&P won't reach 2,500 or even 2,600. That doesn't mean that can't happen. So again, that's one of the things that can throw a lot of people off is we're cautious. You're bearish even, thinking, oh, well, we're at the top. Things are overvalued. We're going to have a crash soon. And you have that mindset, and then it doesn't happen, and then it doesn't happen, and then it doesn't happen, and then it doesn't happen. And you eventually think, maybe I'm just wrong. And then you jump in, and that's when you end up sabotaging yourself. That's what happens over and over and over again when we lose sight of financials and focus on emotions and the fear of missing out and things like that. So I fully expect, I could be wrong, but I will not be surprised, I should say, to see the S&P hit 25 or even 2,600. And because I think it'll feel more extreme before bad things start happening on a significant level, apart from any kind of significant black swan event, which also could happen at any time. And let's see, Bank of America and Merrill Lynch strategists have dubbed 2,500 on the S&P as their target for the quote-unquote Icarus trade. Some of you may be thinking, Icarus trade? Who's Icarus? I've heard of Icarus. It says that also sends bonds. There's basically, when the S&P is 2,500, that could be the thing that sends bond yields, the dollar, and oil higher before their wings melt. And again, Icarus is the guy who flew too close to the sun and his wings melted. And so again, basically seeing 2,500 as an inflection point in the S&P that could kind of send things higher before ultimately leading to their doom is kind of the idea. The observation is made from legendary market watcher Richard Russell, who basically he warned that the market tries to get as many bulls to crowd into an elevator before it heads lower. And they conclude by saying the doors haven't closed yet, but to a claustrophobe, the car is beginning to feel a bit snug. So again, you have that theme that seems to be, it's almost becoming tiresome because we've been hearing it for so long that, hey, we're at high levels, overvalued, like either at a minimum fairly valued, but in almost every meaningful metric, the overall markets are overvalued. But that's where, again, we come back to the idea of value-based investing. And the idea is on a company-by-company basis, finding companies that are undervalued based upon their fundamentals. Their stock value is below what their fundamental book value should be according to your research and estimations. And if that's the case, then there's reason to consider making an investment in that company. Regardless of whether or not you feel we're in a bull market or a bear market or close to the top or a bottom, because the idea is if that individual company is a good opportunity, then it's a good opportunity. But the thing is, once you get into the late stages of a bull market, like I believe we're currently in, there tend to be less good opportunities out there, and that's why a lot of value investors tend to have, at these stages, a lot more money in cash in their portfolios, not because they're preparing for a crash, because they're just waiting for opportunities, which can be different sides of the same coin, but I think it is a very different mindset as well. And then we can't have a podcast like this without obviously getting back to the discussion of interest rates. It seems to be a favorite topic of investors. And it seems like the Federal Open Market Committee, the FOMC, the Fed, it seems to be like there's a strong case that they will raise, or according to the Fed funds future contracts, there's a 94% probability that the central bank will lift its key interest rate target by 25 basis points. I believe that'd be from 0.75 to 1% in the March meeting this month, actually. And so, I think they said to expect 3 rises this year, and they predicted 4 in 2016 and gave 1. And so when they predicted 3 for 2017, most people are like, yeah, whatever. But so if they do raise in this month, that would be pretty significant contrast to what initial expectations were. But I think with the stock market doing as well as it is, I think the Fed feels a little more comfortable in raising those rates, thinking that the market will be able to absorb any kind of potential negative impact of that tightening of the fiscal policy. But again, it's still kind of ridiculous, the fact that Fed decisions like this would be based upon the stock market, because the stock market isn't what puts food on people's plates and isn't what drives the economy. There is an intertwined component for sure, but the fact that, let's see, again, but the consensus seems to be to expect a rate rise in March, but there have been plenty of people, given the Fed dual mandate, wondering why the Fed would be moving now, because the tenor of the economy data hasn't changed. Basically, there's nothing really economically out there, data-wise, that should indicate things are better and warrant a rate increase. And there's also concerns about, basically one thing that could derail a rate increase in March would be a shockingly weak employment report for February. That could be an issue. Something else to watch will be the trend in average hourly earnings, which apparently is predicted to be up only 0.2% for the month. And so that's not positive. And so, yeah, that's kind of where things lie. And in closing, with monetary policy becoming less accommodative, Barclays economists also think the timetable for the Trump agenda is likely to be delayed, and the peak stimulative impact won't arrive until the third quarter of 2018, according to them, which would be just in time for midterm elections, which would be convenient politically. But that is probably a lot later than the markets are anticipating, and I think a lot of the market bullishness has been assuming that Trump is going to do a lot of infrastructure builds and a lot of plans that will help stimulate the economy. And if that doesn't happen in a timely enough basis, that could impact people's views of the stock market and lead to, at a minimum, some significant pullbacks and declines. So that's a lot of what's out there. And that's something else I wanted to point out was it on March 2nd, last Thursday, the Wall Street Journal, the cover story above the fold, top headline, stock surge as optimism rises. Dow closes over 2,100 for first time as inflation nears target. Global outlook brightens. That just sounds like one of those headlines that comes the day before, like something really bad. And not to be negative or pessimistic at all, but again, the whole theme of today's show and a lot of the previous shows have been the idea that bull markets die on euphoria. Basically, when people get more and more excited and optimistic, and you get to that point where you feel like we can't lose, that's when problems arise and hit. And so what you don't want to do is panic and overreact. This is where it's so important to have a personal philosophy of investing, to know what your goals are, how you want to invest, and how you plan to do that. And so maybe you have a strategy that once the markets get to a certain valuation level, maybe you put some money in cash, maybe you buy some hedges. Maybe you do nothing. Maybe you say, I'm in and I'm going to ride this out and let it be what it is. And that's totally up to you. And there are plenty of brilliant people who do that and do very well because that fits their plan. So yeah, you need to have a plan and factor all this in. But my main point with all of it is that I think the writing is on the wall that we are nearing the end of the bull market. And I think it's very wise to prepare yourself accordingly. Again, what that means is up to you. And again, I would love to hear from you in terms of how best I can serve you through this podcast and through Invest from the Family. Some things on my mind. I actually just got finished having a lunch with a financial planner, and I've talked to some different financial planners and investment advisors about ways to collaborate with them to create training for DIY investors or just individuals looking to be more wise about financial management, but especially investing. And that's really where the direction of this business has always been, and where I want it to remain, is on the training component and finding out ways to work with people in that sector, as well as online investors as well, which obviously have been big partners in this business so far. But trying to figure out how I can leverage myself to help you take better advantage of their services, but also be better equipped to do everything fully in-house if you want to, or at a minimum to be more equipped yourself to make better decisions as far as who to partner with on a professional level and what to look for and what to expect from them. I like to use the illustration of a car mechanic or maintaining your automobile. Regardless of if you have a car, regardless of whether or not your mindset is, I want to fully outsource the maintenance and care of this vehicle and just pay someone else to do it all, or you're on the other end of the spectrum saying, I want to do it all myself. Wherever you are on that spectrum, the more you know about your car, the better you understand your car, the better you're going to be able to make decisions in caring for your car. You'll be able to better do it yourself, or better filter and find someone who can do it for you or with you. Same way with investing. I want to provide that to you as investors. If you want to fully outsource things and work with an investment advisor or a financial planner, I want you to be as informed and educated as possible to be able to make great decisions, to pick a great investment advisor or financial planner. There are amazingly wonderful investment advisors out there and great financial planners. There are a lot of bad ones. There are a lot of them who are good salespeople and really don't know much more about investing and financial planning than you do. And so I would want you to be as informed as possible to pick, quote unquote, the best mechanic that you can. Or if you're going to do it all yourself, which I will say, I do think it's very rare that any one of us working as a DIY investor on the side has the time or resources to do it all ourselves. It depends on how active you want to be, I should say. But that's a very, very challenging place to be. And I think in most places, it's very wise to have someone that you are working with or is helping you with decision making, a professional. But regardless of where you want to be, or if you want to be fully doing it yourself, then I want to be the person that helps empower you and give you foundation to do as best as you possibly can. Because at that point, in my opinion, you're a business owner. If you're fully managing your own money as an investor, you need to view that as a business. And if you aren't prepared to view that as a business, then in my opinion, you have no business doing it, because it is there's too much potential for loss. And in the same way, if you had a side business, you'd want to manage it very carefully and make good decisions. And you'd want to make good decisions on who you entrust that to, who manages it for you. And those are all the things I want to help you with here. We'd love to hear from you as far as your thoughts on any of that. Again, you can email me at Brian, BRIAN, at investorinthefamily.com, or just mail, MAIL, at investorinthefamily.com. I can access both of those. Would love to hear from you. But again, that is some updated news this week from Investor in the Family, some things to be aware of. And I am excited to hear from you. I love the emails from all of you. And I look forward to talking to you again soon. Have a great day. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.